So, welcome back to the Web3 Insights and Happy New Year to everyone. Hope 2026 is a prosperous year for all. This is the podcast where we sit down with the founders and builders shaping the future of Web3. So, today I'm thrilled to be joined by Yolanda Liu, who is co founder at Pay Protocol. Pay Protocol is basically building decentralized commercial wallet infrastructure entirely on smart contracts, enabling businesses to accept and manage crypto payments with full self custody. No third parties, no key management risk, and dramatically lower transaction costs. They're currently ranked number 6 by TVL on Tron, according to DeFi Llama, I believe. Are solving some of the most important challenges around crypto payments, security, and capital efficiency. So, Yolanda has been very actively involved as well in high-level industry discussions, including speaking on panels alongside Vitalik. And today we're going to unpack the technology, the business use cases, and what it means for the future of on-chain commerce. So, Yolanda, Happy New Year.
Thank you,
Welcome to the
Aaron.
show.
Yeah.
Pleasure to have you on. Yolanda, for those who may not know yet, could you start by sharing your background and what led you into Web3, eventually to co-founding Pay
Yeah.
Protocol?
So my journey into Web3 started kind of personally. I got into crypto after reading the Bitcoin white paper, like most of people. That was like my high school time. And afterwards, when I was a bachelor student at ETH Zurich, which has a funny name because many people think it's Ethereum Zurich. So I started to build mining farms and mine Bitcoins with some friends. But the moment that truly changed everything was when a centralized custodian we used collapsed and froze over $1 billion in assets in total, including over 800 Bitcoins from me and my friends. So experiencing that loss firsthand made one thing very clear to me. If it isn't self-custody, then it isn't real ownership. So yeah, I would say this is like my first experience and first lessons in crypto. And later on, for my second startup, which is in AI, so where we were selling like a holographic box with interactive AI avatar, I tried to accept crypto payments, and then I got shocked that the industry hadn't learned the lessons from like third-party risk, like the custodian we use and all FTX, because all crypto payment providers I could find were on the market were like still centralized. They hold a customer's funds just like Web2 banks. So yeah, that felt like totally wrong to me, and that's like the moment I decided to co-found it to problem. And yeah, so that's basically how Pay Protocol started, from life experience and a belief that
Yeah.
financial institutions should never require blind trust. And it's funny because recently I just read that even like in history for banks, like back in the ancient Rome and also Greece time, and also recently, like even like banks like like Morgan Stanley and UBS, they've got some like lawsuits because of like a management of like custody. So yeah.
Yeah, amazing. What problem did you see in existing crypto payments and wallet infrastructure, that made you decide this needed a completely new
Yeah,
approach?
so what I realized early on was that crypto payments were built on a contradiction. On one hand, crypto promises decentralization, but the decentralized wallets I could find, like MetaMask or Safe, they were never designed for payments, especially not for C2B high frequency payment use cases. They were great for individuals or simple self-custody, but they break down once you add scale operations and real-world payment flows. And on the other hand, the wallets that are business friendly, like the typical wallet as a service solutions, are almost built on MPC or TEE. That means a third party is always holding a shard of your private key, and all signing happens off chain. But of course, their solutions is much more like seamless for businesses. So yeah, from my own experience, such like MPC structure creates three fundamental problems. First is third-party risk. Like, yeah, we never know if anyone could be the next FTX. And that's why we believe code is law. And the second risk is internal misconduct. Even if a company builds like MPC or TE infrastructure in-house, you are still trusting internal engineers, server access, and operational processes. One bug, one backdoor, or one malicious action can be just kill it all. So by contrast, when wallets are built entirely as smart contracts, once the code is deployed and fixed, no one can change it, not us and not your employees. Moreover, because the contracts are open source, anyone can audit them and verify. There's no hidden logic or backdoor. So, and the third pain point in the industry is gas efficiency at scale. So existing wallet architectures were never designed for high-frequency commercial payment flows. For large fintechs, gas fee can easily turn into millions of dollars per year on one chain. So when I zoom out, it became clear that patching these systems wasn't enough. Payments need a protocol level redesign, not another wrapper. That's why we built Pay Protocol from scratch. We wrote all the smart contracts from scratch as a decentralized smart contract native payment and wallet infrastructure, purpose-built for real business operating at scale.
Amazing, amazing. So Pay Protocol, as you sort of mentioned at the end there, is built as a decentralized commercial wallet infrastructure with a keyless structure. Can you break down how this works in simple terms for any potential founder or operator listening in?
So instead of holding money with private keys or key shards, Pay Protocol wallets are all based on smart contracts. Think of them like programmable vaults on the blockchain. So there are three layers: sub wallets for receiving payments, and then a cold wallet for treasury storage, like for idle funds, and a hot wallet for operational spending. And in this case, like only the hot wallet is like a real wallet, and the cold wallet and sub wallets, they are smart contracts, which are kind of like a sub. They are all like sub contracts from the hot wallet. So none of these sub or cold wallets hold private keys that can freely move funds. So they are like all keyless. Instead, the rules are written directly into the smart contract. So sub wallets can only aggregate or like swap funds to the cold wallet, and cold wallet can only move funds based on predefined governance logic to the hot wallet. And no single person, so in this case, no single person, servers, or key can override these rules. And for managers like C-levels and operators, this means you get full control, but without key management nightmares.
Nice. So full self-custody is, of course, something that many teams talk about, but few actually achieve safely. How does Pay Protocol eliminate third-party risk, internal misconduct and external hacking all at the same time?
So generally, we eliminate these three risks in security because of our keyless smart contract structure of the protocol. So regarding third-party risk, all of our protocol is like on smart contract and it's open source, so anyone can just audit and verify that we are unable to touch your keys or touch your money. And to eliminate internal misconduct, again, because of the smart contract structure, once it's fixed, no one can make a change. So neither us, also nor your employees, like engineers, can write a bug and steal your money. And for external hacking, we can't say we can 100% like eliminate it, because like there's always new way of hacking. We already we can because our sub wallets and the cold wallet, they don't have private keys. So like hackers, because many hackers, they like to hack sub wallets. So then in our case, they don't really have a private key to hack. And additionally, so for the hack happened earlier last year, like to Bybit and Safe, so the front end hacking, we also have a solution to like solve it. Basically, we have another like a guardian, kind of like a verifier. So for each transaction, the distributed guardians on different nodes, they can always like pop up and show the real like a number of transactions so that our clients can like even if the hacker changes the front end of the numbers, it can still be notified and like one to our clients.
Amazing. Yeah, that's incredibly important, and yeah, great to hear. I mean, one of the standout claims is an 81% plus reduction in gas fees, which I think a lot of people will be interested to sort of hear more about. What design decisions in your smart contracts made this level of cost optimization
Yeah,
possible?
so two core decisions. First, we designed our smart contracts specifically for frequent payment flows, not for personal purpose usage. That allowed us to strip out unnecessary logic and optimize execution passes at the opcode level. And second, we redesigned fund aggregation, so fund swapping. And traditional systems, they constantly consolidate funds across wallets, like from sub wallets to cold wallets, especially, which create massive gas overhead. And our architecture, because it minimizes aggregation frequency, because there's like no risk of the sub wallets getting hacked. So that's why at this level, our clients, they don't need to swap like hundreds times per day. And for each time they save like tons of gas fees, especially on like a Tron or Ethereum. So across EVM compatible chains, this results in over 81% gas fee per transaction. And yeah, combined with the frequency, then it can go easily over like over 95%. So yeah, at scale, it's not a nice to have. It's like really a huge difference between like viable and impossible.
Yeah, no, an incredible difference. So Pay Protocol is already, as we mentioned in the intro, ranked in the top 10 by TVL on Tron. What's driven this level of, adoption, and also what type of businesses are using the protocol today?
Yeah, I'm really grateful for this traction we've got so far, especially because it's been driven almost entirely by word of mouth for now. So we don't have a marketing team yet. We only have one BD in-house, but we have like 10 engineers. We are a team of engineers. And what's really worked for us is staying deeply focused on the product and on delivering real outcomes for our clients. I'm especially grateful for the feedback we've received from early clients. Their input has played a huge role in helping us to grow faster and more efficiently. Yeah, like our clients nowadays it's like 70% fintechs plus financial institutions and 30% retail. So for retail, we have like a food delivery app, some also like some marketplace platforms like game, like equipment, shopping shopping platform, trading platform, and some online shops, e-commerce. And for fintech, we have like PSP, so payment companies, card issuers, and neobanks, crypto exchanges. So yeah, that's basically the clients we have right now. But we do have the long-term vision, and we believe that crypto checkout will become something like even bigger in the future. That's also why we initially designed our smart contracts specifically for crypto payments, like checkout, like for gas efficiency and security. So yeah, in the future, we believe we'll have also more and more retail clients.
Amazing. No, it's fantastic to hear, that a lot of that has been done through word of mouth as well, because it's real credibility to the protocol itself. Let's talk about acquiring payments. How does Pay Protocol integrate into a business's checkout flow or on-chain deposit system compared to traditional crypto payment providers?
Yeah, so traditional providers sit in the middle of the flow. Pay protocol becomes part of the business's infrastructure, but without holding or controlling anything from the business client. Like after a business client integrates Pay protocol, no matter they use it to acquire crypto payments or it's or like a crypto deposits, um, the funds acquired go straight into wallets our clients control, not into a third-party account. I would say that's the main difference, because Pay protocol is on the infrastructure layer is a truly open protocol, but never a third-party there.
Yeah, nice. So yield on idle funds is, a huge opportunity for, well, for businesses in general. How does your smart contract cold wallet approach allow companies to earn yield through, integrations like Aave without, sacrificing custody or
Yeah, so
security there?
with Pay protocol, the yield happens inside the wallet, not outside of it. Our cold wallets, they can interact directly with defined protocols like Aave. So funds never leave the merchant's custody, like the merchant's self-custody, and no assets are parked with third parties, and all interactions are governed by the same on-chain rules predefined by our clients. So yeah, treasury yield becomes a native function of Pay protocol,
Hmm.
the wallet, like smart contract wallet, not a separate operational risk.
Okay, cool. You recently spoke on a panel at the same event as Vitalik. What were the key themes, you discussed there? How do those conversations reflect where Web3 infrastructure is heading next?
Yeah. So the recurring theme was simplicity and reliability. Vitalik, he emphasized that long-term adoption will not come from complex mechanisms. It will come from simple, low-risk primitives that institutions can actually trust. And that totally aligns with how we think about payments, like simple setup, minimal intermediary risk, and a clear auditable rules on-chain, code is law, and to solve the real-world problems. So Web3 infrastructure is for sure maturing, and our goal with Pay protocol is to be a fundamental protocol layer that anyone can deploy on, not only for direct clients like retail or fintechs, but also for companies that want to provide our protocol to their clients with their brand. So this is similar to how, even like Ethereum scaled up, right? Like there are so many the apps and also layer 2s built on Ethereum, and they are growing super well now. It's also similar to like how Base is built on OP Stack. So yeah, and how tons of like AI applications, like unicorns nowadays, are built on LLMs. So yeah, that's how truly scalable infrastructure gets built, and that's also our goal with Paper.
Nice. So from your perspective, what are the biggest misconceptions businesses still have when it comes to accepting crypto payments or managing on-chain treasury?
Yeah, the biggest misconception is for me is that custody can be outsourced safely. I just mentioned, like even with banks in the history, so many scandals have happened because they mismanaged customers' like funds or assets, and many businesses assume someone else should hold their assets because it feels easier or more institutional. But there could always be like a black one. So in reality, custody is where most risk accumulates. Another misconception is that crypto payments are still experimental. At this point, stablecoin-based settlement is often faster, cheaper, and more transparent than traditional rails, especially cross-border. Last year, we can already see that the adoption is like really getting like widely growing.
Hmm. Yeah, absolutely is. And you can definitely see that year on year about how widely it's becoming more and more adopted as the years go on. So looking ahead, what does the Pay protocol roadmap look like, especially over these next 12 months, both from a product and the ecosystem expansion point of
Yeah.
view?
So product-wise, we aim to like achieve deeper define integrations and do more audits and provide a better agentic experience to our clients. And ecosystem wise, of course, like we always want to acquire more clients and also have more white label deployments launching. And we will launch our tokens once our monthly volume surpasses 500 million. Then we will prepare for the prepare the foundation for protocol level governance and token economics. In general, our focus is always like scale safely.
Yeah. Do you have I know this is probably how long's a piece of string, but do you have like a rough timeline for when you anticipate the token launch to be?
Yeah, since we only want to launch the tokens once the monthly volume surpasses $500 million, and that's what we aim to achieve in a year. So hopefully before Q4, based on our current MOM. So that's the forecast.
Nice. That'd be
Thanks.
amazing. And finally, just to finish up for founders, fintechs, and Web2 businesses, exploring crypto payments for the first time, what advice would you give them before choosing their infrastructure stack?
So I would say don't optimize for convenience first, and optimize for control and survivability. And ask yourself, who can move my funds? What happens if a provider disappears? Can I verify everything on-chain? Crypto payments shouldn't recreate the Web2 risk with new technology. They should eliminate it. So choose the infrastructure that aligns with the principle from day one. Code is law.
Nice. Amazing. Lovely way to finish up. Yolanda, it's been a great conversation. I really appreciate you, breaking down the technical side while keeping it practical for operators and founders. For anyone listening who wants to learn more about Pay Protocol, you can check them out at payprotocol.network. I will also attach some links to their socials and everything else. So do go and follow the team on LinkedIn and stay up to date with their latest announcements. As always, if you enjoyed the episode, make sure to like, share, and subscribe on Spotify and YouTube, wherever you get your podcasts, and share it with someone building in Web3. But thanks again for tuning in to Web3 Insights, and we will see you next time.
Thank you, Aaron.
Yolanda.